Good morning, everyone, and welcome to QuotedData's Property Investment Conference. I'm Richard Williams, Property Analyst at Quoted Data, and thank you all for coming. And it's so good to see so many of you in the room and actually be here in person for the first time since 2019 for us. Just a bit of housekeeping before we start. So there's no planned fire drills, and the fire exit light over there if it does go off. So like I said, we're really excited to have you all here today and be back in the room and hosting in-person events again. We believe there's no substitute for face-to-face meetings and events, but we do realise that not everyone can make it, so we also live streaming today for those that can't be in attendance, and we welcome our online viewers. We want to make this event as engaging and as interactive as possible, so there's going to be ample opportunity to fire questions at our panellists, and we absolutely encourage this. All the seats in the auditorium have microphones. You just click the button when you want to speak. And for those streaming, pop your questions into the Q&A function in Zoom, and we'll get those put to the panellists. As for the panellists, we believe we've assembled a fantastic lineup today, and we're covering a breadth of property subsectors and investment strategies. And we'll hopefully leave here today with no stone unturned and plenty of food for thought. We'll be covering everything from debt, occupier trends, investment markets, to the future of offices, where now for logistics, and the fresh hope for retail. A running theme throughout the day is undoubtedly going to be valuations. The question I'm asking myself regularly right now is what's going to trigger a re-rating of the sector and the change in sentiment? The divergence between net asset values and the values that investors are attributing to companies right now is huge. Okay. So on this slide, you can see the average discount of the UK property companies over 10 years. And this illustrates just how wide discounts have got in the last few months. The average 30% plus discount that REITs and listed property companies are trading on compares to a 10-year average of around 12%. That suggests that the sector is cheap and there's value to be found. When you have quarterly and half-yearly valuations, there's always going to be some divergence, especially during this time of economic turbulence. But levels of 30% plus, clearly the market is A, pricing in further pain from interest rates or even a recession, and or B, do not trust the reported NAVs. The question of valuations and the extent to which they are reliable and the market can have confidence in them has been on the lips of every self-respecting investor for decades. Going back to the global financial crisis, we all knew that values were not adjusting appropriately and fast enough. However, this time around, we've seen a rapid movement downwards, perhaps the trust quartering effect on values. Valuations have adjusted as the cost of money has adjusted, and rightly so. This pace of valuation movement hasn't always been the case in the property sector. Valuers this time around were quicker to react, with values falling quicker than in the aftermath of the the global financial crisis. This graph from the MSCI shows UK property valuation declines during the different downturns, with the time period on the bottom axis. As you can see, capital values have fallen faster during the current period, which is the blue line, by around 20% in 8 months, than during the global financial crisis in yellow and the 80s and 90s recession in orange. There are many views on valuations in the sector, and I'm sure we'll hear plenty of them today. But in my view, this is a good thing and should give investors confidence in the values. We all remember the debacle surrounding the retail sector, especially shopping centres, in 2015 and 16. It was obvious that rents were under intense pressure from a seismic change in the supply-demand dynamic. But despite this, values were stable quarter after quarter against all this logic. Thankfully, this was not lost on the RICS and has prompted a review in valuation methodology. And the Red Book probably not going to be rewritten, but there are changes afoot. It's been recommended that a discounted cash flow methodology will become the primary method of valuing individual assets and portfolios going forward. The principle is that the cost of money should drive valuations. The risk-free rate and the risk premium should be a major ingredient into the discounted value of a series of likely future cash flows. And that's, in our view, a good thing. The hope is it will provide greater confidence to users of those valuations, and the valuers and the valuations will be that much more up to date. Sentiment would still be taken into account, and valuers will address that. So it seems that valuations on comparable market transactions, which is by definition backward looking, could become a thing of the past. What the changes will do, though, is take away that conflict of interest that has existed between the big investors and some of the property agents, and in our view, has diminished trust over the years. It will also increase reliability and confidence in values, as I mentioned. So the substantial valuation correction witnessed in the second half of last year, which is illustrated here with the largest quarterly fall in the history of the MSCI index at 15.6% in the fourth quarter, has resulted in a shorter price discovery period and has allowed the markets to start trading in greater volumes again. We're now seeing deals happening with numerous examples of prices at or even in some cases above book value. This has meant that values have started to stabilise with a 1.2% decline in the first quarter of this year. If we look at the monthly data, March saw the first positive valuation move since June 22 at 0.2%. I should point out that the index tracks the performance of 1,500 property assets with a capital value of about 29 billion. So this recovery in values was led by industrial and logistics sector, retail and residential. And we believe the performance is likely to come from these sectors going forward, which benefit from positive underlying fundamentals. And obviously these were the sectors that experienced the largest correction late last year. So industrial and logistics, supermarkets and retail warehousing look strong in our opinion. This combination of potentially stabilising valuations and improving sentiment has not been lost on the private equity guys. US private equity giants are circling the sector more now than ever. We've seen Centmod and GCP Student Living taken private in recent years. And just last month, Blackstone bid for Industrials REIT, whose CFO is incidentally joining the panel later today, so that will be interesting. The offer was at a massive premium to its share price, but also a material premium to its NAV, which is quite interesting and really goes to show the growth potential that they see in this sector. In normal times, this has been the catalyst for a re-rating of the sector, especially the industrial and logistics focused companies, but so far it's not really been much. We expect to see many more private equity bids taking advantage of this mismatch in valuations. Those companies operating in sectors with robust fundamentals, rental growth prospects and strong management teams will be most attractive, as was the case with industrials. So when will we see a re-rating and sentiment change? Well, obviously a lot will depend on inflation and when that is brought under control, and when we can see a plateauing and eventually a fall in interest rates, as long as this isn't recession induced. Inflation has remained stubbornly high and it's been harder to tackle than first thought. Talk now of food prices coming down and also energy costs coming down is good news, but tight labour market could prove a sticking point. All eyes then is on the inflation data and any indication and the rhetoric from the Bank of England on when the rate cutting cycle will begin. Like I said, today we will leave no stone unturned in exploring all things commercial property, covering valuations, sector fundamentals and investment strategies. And at the end of the day, we have an exciting panel on technology and the future of the real estate.